This video is solely for educational purposes. We will not be responsible for any losses or gains you may incur. Hello everybody. In this video we will be starting with the chapter 5 of CMT level 1, which is of the section number 2, charts, trends and patterns. So we'll be beginning with the chapter number 5, trends, the basics. So here we are going to learn about what is a trend and what are the basics of the trend, even though we have started with it earlier. What are we going to learn in this chapter? We are going to learn how to explain, and we will be able to explain why trend identification is important to achieve profits. So in the first place, why do we have to identify trends? Recognizing an uptrend, downtrend and a trading range. Describe the concept of support and resistance and the underlying psychology. Identify trends using most common methods. Recall how significant reversal points are identified and the general rules of trend lines. So these are the basic concepts which we will be going over. Before we begin, let's just revise our Dow theory. So trend is the key to profits. So we need to remember that profit with minimum capital risk in the securities market is the sole objective, and technical analysis is an effective way to profit as well as controlling our risk. The key to profiting in the securities market is to follow these 3 steps. So the first step would be to determine with minimum risk of error when a trade has begun at its earliest time and price. So we must be able to identify when our trend has begun in the first place. The second would be select and enter a position in the trend that is appropriate to the existing trend regardless of direction. So we need to enter into the trade in the direction of the trade, whether it is upwards or downwards, whether we want to go long or we want to go short. Close those positions when trade is ending. So we need to get out of the position as soon as our target has been achieved. Trending is a simple, trending, this concept is simple when you read about it, but it is difficult to practice. So trends define the direction in prices, right? It helps us to identify it. And what is a sideways trend? A sideways trend is a neutral area or a trading range. That's what we call it as a range bound market. Okay, now the basis of trend analysis was given by Dow theory. Trends are fractal, which means the time frame concept. Trends tend to continue rather than reverse. So when an uptrend is going on, you need to be going long. You can't short there. Okay. Any particular trend is influenced by its next larger or next smaller trend. What does that mean? So we can see a well-defined uptrend in a stock. It is not a straight line upward. Within the rising trend, there are many smaller trends, both down and up. So that is what they are trying to say. So when we see a chart, let's go to my trading view. Let's look at my chart. Look at this. If we go on a daily time frame, or let's say we go on a weekly time frame. I hope it's clear. No, let me just go on a daily time frame. Okay. If you look at the chart, the primary trend is going up, but inside there is a smaller trend, and even inside that there is a smaller trend. So that is what we are discussing, that the trends are fractal in nature, and the bigger trends are always affected by the smaller ones, and the smaller are affected by the other trends. So that is the concept which we have to keep in mind. Okay. So now we begin with the most interesting concept, which is the trend identification. How do we determine a trend? So trend is a direction rather than a line. This is one thing we need to keep in mind. The trend is a direction and not a line. If we look at the chart, if the price is going up, it goes up like this. It never goes up like this. And when the price is coming down, it goes down like this and never in a straight line. So trend is usually a direction and not a straight line. So the trend doesn't move in a line. The trend will be moving in a particular direction. Okay. So now we already know what is an uptrend, what is a downtrend. When we are talking about uptrend, it is creating higher peaks and higher troughs, which is higher highs and higher lows. And when the market is going down, it is creating lower peaks and lower troughs, or lower lows and lower highs. So that is my downwards trend. And my trend is in consolidation or a range bound. This is a sideways trend where my peaks and troughs are not really creating any higher peaks or higher troughs, or lower peaks or lower troughs. So if we go and check out the trading view, if we go and see our trading view charts, let's go to Nifty 50. It's not loading. Okay, now I've opened up the crude oil futures India chart. So if you look at this, what can we identify? Look at the chart and tell me what you can identify. If you can see here, from here to here, I don't know if you're able to see, because there is no pen on investing.com. I can't doodle. But if you see that here, from 2022, just look at the x-axis, from 2022 530 to 2022 930, the stock, I mean crude oil, was in a downtrend. And if you look at here, from 2022 11/24 to, let's say, 2023 3/8, crude oil was in a sideways, because it is not creating any higher highs or any higher lows, or lower lows and lower highs. Let's look at this. This is a clear uptrend, higher peaks and higher troughs. This is a clear sideways trend over here. Again, looking at this part, from 2021 1 to 2024 2. So this looks like the COVID crash to me. This is the exact time when the COVID lockdown and everything happened. So you saw that the price of crude oil also fell really badly. So this is a clear downtrend over here. Why? Because it's creating lower peaks and lower troughs. I think it's a visual concept, and now you know it. So go on your investing.com, go on TradingView, pause the video and try to identify the trends. Look at this. Again, 2019 6/21 to 2000, let's say 19 11 18. It's a clear sideways trend, because it is not creating any new higher highs, higher lows, or lower lows and lower highs. Here again, from 2018 9/28 to 2018 12/24, we have a clear downtrend over here. We can look at this, and here again we have a beautiful uptrend. So now that is how we are going to determine our trends. Okay. Alright. We've discussed what a peak and a trough is. This is my peak and this is my trough, and I hope you can identify that in the chart as well. Okay. The configuration usually occurs after a larger trend has come to a temporary halt. A trading range is also called a consolidation, congestion, or a rectangle formation. So all of these are the names for sideways trends only. So after a big bull run, the market consolidates in a place. So this consolidation phase is known as a rectangle formation, because it looks like a rectangle. It is known as consolidation, or it is also known as congestion area. where the stock price has congested. So that is how we can identify a consolidated area or a range, a trading range. So these are all the different names of the same term. So whenever any of these are mentioned, you need to know that we are referring to the consolidations only. So Charles Dow called small lateral patterns a line formation. So what is a line formation? Line formation is also these small consolidation. Charles Dow called this a line formation, which means it is my consolidation. Now we come to support. Now what is a support? Logically, what is a support? Let's say this is my platform and I put a ball on the platform. My ball came here, it was falling, bounced on the floor and again went up to the air. What did the ball do? The ball took a support of this surface. So this wall over here, this platform over here acted as a support. That is what is support. Now, what is a resistance? So there is a wall above me and I throw my ball up. My ball touches the roof and it falls back down. So what did my ball do? The wall above over here resisted and my ball resisted from going further up and it fell back down. So this is my resistance area. I hope you are clear with the concept. Now how am I going to find that? When prices have been rising and then reversed downward, the highest point in the rise, the peak, is referred to as a resistance point, a level at which the advance has met with selling resistance. A resistance level. Okay, let's first see examples of this, then we will see the other things. So I'm back to my Nifty 50 chart and this is my daily chart. Let me go to a 30 minutes chart. So look at this. Let me just give you some examples. Just understand it in a very logical manner right now. So you see the price came down, the price took a support over here and it boomed up at this particular point. So this point is my support point. Why? Because why? Because my price took a support from there. Now look at this point over here. My price was going up, resisted over here and then it came crashing down. So this point is my resistance point. So that is how you are going to identify your support points and your resistance points. Let's go further now and let's see more examples over here. So the support points or the resistance points can also occur diagonally. What do I mean by diagonally? Look at this point and this point. Okay, now let's look at this point. No, let me find a better place. Alright. Okay, now look at this example over here. This line which I drew. Why did I draw it? My price came down, took support from here, bounced back up. Came down, took support here, bounced back up. Came down, took support here, bounced back up. So this line over here is acting as a support and this is diagonal support. Don't get confused, but this is a trend line. And this is something which we will be looking into the detail in the further chapters, but just keep that in your mind. So now I hope you know what is a support point and what is a reversal point, what is a resistance point and what is a support point. So the price is coming over here the price was falling, took support and boomed up. So this is my support point. The price, this is the price went up, took resistance over here and came back down. So this is my resistance zone, resistance point, or my reversal point. So that is how you identify your reversal points and your support points. Okay, now there's one thing you need to know, keep that in your mind. Once the support points are not permanent, it can be broken down. The resistance points are not permanent, it can be broken up. Sometimes the platform breaks and my ball goes further down. That is possible. And resistance, my ceiling can just break and my ball can go up. So that is a possibility as well. So no support and resistance is permanent in nature. It can always be broken down. So if you look at this, let's say okay, so look at this area over here. Look at this. You can see that the price went up till here, came down, went up till here, came down, tried to go up, came down. So that was a resistance point, right? The price was resisting from going further up. But here what happened? The price broke the resistance level and went up. So that's what I'm trying to say, that the support and the resistance are not permanent. It can be broken down. The same way, if you see supports, you can see support over here. That's an example, support over here. The price came down, took support, went up, took support, went up, took support, and it broke down and it went further down. So here my support has been broken. Alright. So one more thing. Once a support is broken, it becomes a resistance, and once a resistance is broken, it becomes a support. I'm repeating. Once a support gets broken, it becomes the resistance, and once a resistance gets broken, it becomes a support. Let's see examples of the same. Let me go on a shorter time frame. I'm just going to a stock so it is easy for us. So I'm opening the Nestle India stock. And if we look at the stock, if we go on the daily chart, okay, now look at this. This place over here, my stock went up, came down, went up, came down, went up, came down, went up, came down. So it was resisting over there. And once it went up and came to that place again, it went up again. So the same area now becomes my support. Now the stock took a support in the previous resistance and shot up again. So that is what I'm trying to explain, that once the support line is broken, it becomes the resistance, and once a resistance line is broken, it becomes the support. We can look at n number of examples. I'm trying to find it real time for you instead of preparing it from before, because this is how the real markets are going to be like, right? So you need to see the reality and not just study practically. Again, nothing in technical analysis is 100%. There are going to be some times when things are not going to work your way. Okay, now look at this. If you just see this support area over here, support going up, took support, went up, took support, went up. Now finally the support has been broken. The price tried to go up, took resistance from here and came down. You see that? So that is what I meant when I said that support becomes resistance when broken and resistance becomes support when broken. So I hope that is clear. Now we'll look at a very interesting concept in which is known as a zone. Again, we have discussed this multiple times that the price never goes in a line, it goes in a trend, right? So what are a support zones? So now if this is 700, if my stock came down and went up, right? And the second time it came down and went up from 700 only. This is also 700 only. So my support point is going to be 700. But what if my stock took support at 700, went up, took support at 69 and went up? So this is 70 and this is 69. But however, both of them are very, very close by. So this zone is going to be called as my support zone. The numbers between 69 and 70, this entire zone, instead of having one support line, now we have an entire zone which is the support. That is what we are trying to explain when we're talking about zones. So if you want, we can check some examples for the same. Okay, now look at this. Here I know that the market took support, here also it took resistance. It took resistance here, went down, resistance here, went down. And now if you look at this, it took resistance here, went down. So it took resistance from here also and here also. So I can just mark a zone here, right? So how am I gonna mark a zone? I can make a rectangle over here. There are various ways to do so. So between both of them, I'm going to just make a zone like this, and I'm going to extend my zone. So the next time my stock came to this zone, it reversed down here again. Even though it broke it later on, but it did reverse and react to this zone over here. So that's how you are going to identify zones. Again, look at this. So my price is reversing from here and here. Yeah. So if I look at this, my price went up, came down, went up, came down. Here it took a higher place. So it is starting from here, but it's taking resistance from here also. So that's how I'm creating a zone over here. The zone, again look, it came to the zone, took a resistance, had a small pullback, and then it broke. So that is how you create zones. Now we come to a new concept, which is the round numbers. Now, this is something which is related to the psychology of the people in the market. We are always thinking in the round numbers. If I talk about when we go to H&M or when we go to Zara, the price in India is going to be 799, rupees 799 or rupees 999. or it's never gonna be $100. They're gonna price it at $99. Why is that happening? They could have just put it as $100, right? But they're wantedly putting it like this because we always think in round numbers. We are always going to round it up to 90 instead of 100. We are going to round it up to 700 instead of 800. We are going to round this up to 800, 900 instead of 1000. So that is how we are going to react to these prices, and that is a psychological concept. Humans always think in round numbers. So these round numbers are also going to play an important role in the stock market. The round numbers act as a psychological resistance or a psychological support. Even if my price action is not giving me any signal that this is going to be a resistance zone, but since it is a psychological zone, just a second. Since it is a psychological round number, it might act like a psychological resistance. Like for example, if you think about this, 18,800. Okay, 800 is a round number. So if I make a horizontal line over here, 18,000. Okay, somewhere over here. Yeah, 18,800. Look at this. If you see this, the price stayed over here for a long period of time. It didn't break it for these many candles. So it took a support over here, went down and then broke out, but it spent a considerable amount of time over here. Again, when it went up, it took support over this round number figure and went up. So the round numbers are my psychological support or psychological resistance, which play an extremely important role. So you are assumed to keep that in mind as well. You are expected to, not assume. Alright. So that was about my round numbers. Moving on, we're now starting with how are important reversal points determined. So there are various methods which I'll be using in order to determine the reversal points. What do you understand by reversal points? If my primary trend was going up and now it's going down, this is my reversal point. If my trend is going down and then it went up, this is my reversal point. So that basically speaks about the reversal in the trend, reversal of the direction, reversal in the market trend direction. So let's begin with the first method, which is DeMark or Williams method. Now what is DeMark's or Williams method talking about? Tom DeMark and Larry Williams each have a method of determining a reversal point by using the number of bars in a bar chart. So DeMark Williams talks about using the bar chart method. So using the number of bars on either side of a suspected reversal point, in a low bar for example, the analyst might look for 2 bars with higher lows directly on either side of the suspected trough of the bar. The number of bars on either side can be increased. So what do you mean by that? I will explain using the chart only. So this DeMark and Williams method is done on a bar chart only. So how to identify an expected reversal point? So I'll tell you. So whether to identify a particular point as a trough or a peak, that is the reversal point, right? So if I look at, oh my god, just a second. So if I look at, let's say a bar like this, okay, so if it should be a peak, then my previous 2 bars have to have, okay wait, I'll just first teach that in a theoretical manner. Okay, again. So again tell me, if it's an uptrend and if it has to go down, if I have to identify a peak, then my previous low should be lower than my current low, and my previous high should be lower than my current high. Obviously, since it is creating higher highs and higher lows, if this is my candle I am referring to, then I should make sure that this candle is higher than my previous two candles. Then only this is my peak point. Very understandable. Now if I have to go to a trough point, and if I think it's going to reverse from here, then this point should have lows, lower, and highs and lows both, which are lower than my previous candles. So how am I going to do that? Now if I look at the chart, look at, let me get an example. Okay, look at this candle, this green candle. It has a higher high than my previous candles. It also has a higher low. So this is my reversal point. It has two candles, right? So from here, look at how the price is pumped down. So that is how you identify peaks or the reversal points. Now let's go to and see another example. Now let's try to find out a trough. Alright, we got a perfect example over here again. Look at this candle over here. And now look at the other two candles. The other two candles, high is higher than this candle and low is also higher than this candle, which means this candle is lower than both of them. So this is my reversal candle. Look at this, how my price pumped after that. So that is how you identify reversal points using Demark's or Williams method. Let's see more examples over here. Okay, look at this candle over here, bar over here. This one. Now this bar has higher highs than both of them. So this is giving me a reversal signal. Look at how my price pumped down. So that is how you identify reversal points using Demark or Williams method. So what is the basic concept here? That for the highest point or for a uptrend reversal, then the last candle is going to be higher than both the previous candles. And obviously the more candles the better. And when there is a downward reversal, when there is a downtrend reversal, then the candle must be lower in both aspects from the previous two candles. This is done in the bar chart only. So this was my first method, which was Demark's or Williams method. Now we'll be beginning with the percentage method. What is my percentage method? So this is another method of identifying significant troughs, and we can decide beforehand how much price should decline into and rally from the trough. So for this requirement, we'll be using a percentage. So for example, using 1%, anytime the price declines more than 1%, makes a low and then rallies more than 1%, would define a 1% trough. The larger the percentage used, the more important but less frequent the reversal point. So if my price went low by 1% and rallied up by more than 1%, I can say that there has been a trough of 1%, because after this my price rallied more than 1%. So that is how I use my percentage method. Now we are doing the next method, which is Gann 2 days swing method. So Gann swing method is more or less related to Demark's or Williams method, but it is a little bit different. To find a support point, a trough, a low, just a second, yeah. To find a support point, a trough, a low bar, Once the low is identified, the two following trading days are observed. If these 2 days have higher highs than the low bar, then the low bar is the support point. Okay, so this is something which is more or less related to just like my DMARC or Williams method. Now, what is the difference between the Gans method and the DMARC-Williams method? In DMARC-Williams method, we just identified the reverse points, or we just identified the side of the trough and peak. But in GAN 2-day swing, we will be using only 2 bars. In DMARC-Williams, we were using 2 or more bars, but in GAN 2-day swing method, we will be using only 2 bars. So using that, we can analyze my reversal. This is similar to this, and we have already. So DMARC-Williams method and GAN 2-day swing, both of them are done in a bar chart. So keep that in your mind. Now we come to the last method, which is my high volume method. Very large volume can also identify a significant reversal point. High volume indicates that larger than usual activity occurred on the trading day. Shows a 1-day reversal. Alright. So if you see a high volume, then we can identify that reversal can happen in that direction. If we go to our charts and we go on our, so I have my volume chart over here. Look at this. There is a big red candle and my volume is high, which means a reversal can happen. Look at this, the price pumped down. So wherever there is a high volume, it is a confirmation that a trend reversal might be occurring. Let's see more examples. Look at this. This green high volume candle. After this, the price pumped. Again, look at this highest volume over here. My price went up. So that's how we are going to use the volumes. So how are important reversal points determined? DMARC-Williams method, percentage method, GAN 2-day swing method, high volume method. So you can use these methods. Now, how are support and resistance is drawn? We have decided this. We have discussed this already, but you can just go on the charts and try to identify it. We have already discussed how to draw supports and how to draw support zones as well. Okay, so like for example, if I have to draw over here, I'm just going to connect these points. Why am I connecting this? Because the support touched here, went up, touched here and went up. So I can see that this is a significant support because every time it is touching, it is going up. Here my support has been broken, obviously. So that is how you are going to basically identify support and resistances, and you are going to construct them. So try to do it by yourself. In the next video, we will be continuing with the chapter and we'll be seeing more examples, and we'll be seeing more aspects. Let me just quickly go and check more. Alright, now look at this. If you look at this, my price went up, came down, went up, came down, went up, came down, went up, came down, went up, came down. So this is my resistance level, and then my price went down. Now how do I draw trend lines? You connect the peaks and troughs. For example, what I'm seeing right now, I have connected this high and this high. It's going down. So this is how I make a trend line. So trend lines also act as a support and resistance. So that is it with this chapter. For this video. In the next video I'll be continuing with the chapter. Thank you.